You don't lose money because you don't earn enough. Most people lose money because they feel too much at the wrong moment. Because the truth about money only changes your life when you actually reflect on it, not just hear it. Emotional spending is one of the most silent wealth killers in modern life. It doesn't look dangerous. In fact, it often feels good. A new phone, a new outfit, a new gadget, or even small daily treats. Each one feels like a reward. But the psychology behind it is simple. You are not buying the item, you are buying relief. Relief from stress, relief from boredom, relief from comparison, relief from feeling like you're behind in life. Think about a young office worker earning a decent salary. The moment he feels stressed after work, he opens an online store just to look. Within minutes, something catches his eye. He convinces himself, I deserve this. The checkout button is clicked, and for a brief moment, there is satisfaction. But that feeling fades quickly, often replaced by guilt or financial pressure before the month even ends. This cycle repeats silently, not because people are careless, but because emotions are faster than logic. The brain releases dopamine not when you own the item, but when you imagine owning it. That anticipation becomes addictive. Now pause for a second and ask yourself, how many of your purchases were truly planned, and how many were emotional reactions? This is where wealth quietly gets destroyed. Not in big dramatic failures, but in small emotional leaks that never stop. And if this part already feels familiar, wait, because what comes next will challenge the way you see fear and money even more. But before that, if this is making sense to you, like subscribe and comment control, if you feel emotional spending has ever controlled your decisions more than you controlled it. Because the first step to building wealth is not earning more. It's learning to separate emotion from money decisions. Fear of risk is one of the most powerful invisible forces shaping your financial life. And most people never even realize they are living under its control. Before we continue, subscribe, like, and comment what fear has stopped you the most in your financial journey. Because awareness is the first step toward breaking it. Imagine two people standing at the same starting point in life. Same income level, same opportunities, same intelligence. One of them takes small calculated risks, starts investing, tries a side business, learns new skills. The other stays safe, avoids uncertainty, keeps everything in a savings account, and waits for the perfect moment. Years pass. The difference between them is not luck. It is fear tolerance. Fear of risk doesn't feel like fear in the moment. It disguises itself as logic. What if I lose money? What if this doesn't work? What if I regret it? These questions sound responsible, but often they become a cage. Because while you are protecting yourself from possible loss, you are also avoiding possible growth. There is a story of a man who worked in a stable job for over 15 years. Every time he thought about investing, he remembered someone who lost money in the stock market. That single story shaped his entire financial behavior. He never entered the market. He kept saving, feeling safe. But over time, inflation quietly reduced the value of his savings. He didn't lose money in a crash. He lost it slowly, safely, and invisibly. Meanwhile, someone else with the same income started small. Not aggressively, not recklessly, just consistently. A small monthly investment, a little learning, a bit of discomfort. Years later, the difference wasn't just financial. It was freedom versus limitation. This for a moment, because this is the part most people miss. Fear of risk doesn't protect your future. It often quietly limits it. Real wealth is never built in complete safety. It is built in controlled uncertainty, where you learn to manage risk instead of avoiding it entirely. And if this is starting to shift your thinking, subscribe, like, and comment risk if you're beginning to see how fear has been shaping your decisions more than you realized. Because next, we go into something even more deceptive, the difference between looking rich and actually becoming rich. Looking rich and actually being rich are two completely different realities. But in today's world, they often look almost identical on the surface. Before we go deeper, subscribe, like, and comment what you think matters more, status or freedom, because this distinction quietly defines your entire financial future. Scroll through social media for a few minutes and you'll see a carefully constructed illusion of wealth everywhere. Expensive cars, luxury dinners, designer clothes, perfect vacations. It creates a feeling that everyone is winning at life except you. But what most people don't see is what happens behind the scenes. Credit payments, debt, delayed rent, and financial stress hiding behind curated images. There is a powerful psychological reason people chase looking rich. It is social validation. Humans are wired to seek approval. When someone drives a luxury car or wears a high-end brand, they're not just buying comfort. They're buying attention, respect, and sometimes even self-worth. But here is the hidden cost. Every dollar spent on appearance is a dollar not invested in actual wealth building. There's a story of two friends who started working at the same time. One focused on upgrading his lifestyle quickly. New phone every year, expensive clothes, eating out frequently, and financing a car to look successful. The other kept his lifestyle simple. Same job, same income, but a different priority, investing first, lifestyle second. After 5 years, the first friend looked successful from the outside, but was living paycheck to paycheck. The second friend didn't look impressive at first glance, but had built enough investments to change his financial trajectory completely. This idea, because this is where reality becomes uncomfortable. People often sacrifice real wealth just to appear wealthy to others who are also pretending. The irony is that true wealthy individuals rarely feel the need to display everything. They understand that money is not for validation. It is for freedom, time, and options. Their focus shifts from impressing people to building systems that generate income without constant effort. And if this is making you rethink what you see online and around you, subscribe, like, and comment real if you're starting to see the difference between image and reality. Because next, we go into something even more powerful. The mindset shift that separates people who stay stuck from those who actually build wealth. Long-term thinking with money. Most people don't fail at money because they lack opportunity. They fail because they think in short time frames inside a long-term game. Before we continue, subscribe, like, and comment how far ahead you usually think financially, because your time horizon is quietly shaping your entire life. Human brains are naturally wired for short-term rewards. We want results now. We want comfort now. We want certainty now. But wealth doesn't respond to urgency. It responds to patience, consistency, and time. Think about two individuals earning the same salary again. One thinks in terms of the month. Can I afford this right now? The other thinks in terms of years. Will this decision benefit me 5 years from now? This small difference in thinking creates completely different financial futures. There is a story of a man who delayed investing for almost a decade. Every year, he said the same thing. Next year, when I earn more, I'll start. But lifestyle also expanded with income. Expenses grew silently. Comfort increased. And the habit of postponing became permanent. When he finally started, he realized something painful. The biggest loss wasn't money. It was time. Because in wealth building, time is not just a factor. It is the most powerful force. This idea, most people overestimate what they can do in 1 year and underestimate what consistent action can do in 10. Long-term thinking changes behavior in subtle ways. It makes you question unnecessary spending. It makes you prioritize learning over luxury. It makes you focus on systems instead of impulses. It shifts your identity from earner to builder. And here's the uncomfortable truth. People who win financially are not always smarter or luckier. They're simply more willing to think beyond immediate gratification. They understand that money is not built in spikes of effort, but in slow compounding of discipline over time. If this is starting to reshape how you view your decisions, subscribe, like, and comment. Long game if you are ready to start thinking beyond short-term comfort. Because next, we break down one of the most misunderstood concepts in personal finance, saving versus investing, and why one of them alone will never make you wealthy. Saving feels safe. Investing feels uncertain. But only one of them is capable of building real wealth over time. And most people only ever rely on the first. Before we continue, subscribe, like, and comment whether you feel safer saving or investing, because your answer reveals more about your financial future than you might think. Saving money gives a sense of control. You see the number grow slowly in your account, and it feels stable. No risk, no stress, no surprises. But there's a hidden problem most people ignore. Money that only sits still is actually losing value over time due to inflation. So while your savings feel safe, their purchasing power quietly shrinks in the background. Investing, on the other hand, introduces discomfort. The numbers go up and down. There is uncertainty. There is fear. That's why most people avoid it. But this is exactly where the mistake happens, because wealth is not built by avoiding discomfort. It is built by learning how to manage it. Think about two individuals again. One keeps saving diligently for years, believing he is doing the right thing. The other also saves, but uses a portion to invest consistently in assets that grow over time. At first, the saver looks more stable. The investor looks risky. But after a decade, the difference becomes undeniable. One has preserved money. The other has multiplied it. There's a powerful psychological trap here. Saving feels like progress because it is visible and predictable. Investing feels like uncertainty because results are delayed and fluctuating. But wealth is not about comfort. It is about expansion. This thought, if saving alone made people rich, every disciplined saver will be financially free by retirement. The truth is, saving is protection, not growth. It keeps you safe from emergencies, but it does not move you forward. Investing is what allows money to work even when you're not working. It is the shift from linear income to compounding growth. And this is where most people stay stuck. Not because they don't save, but because they never transition from saving to building. If this is changing how you think about money, subscribe, like, and comment grow if you're ready to move beyond just saving and start building real wealth. Because next, we go into one of the most powerful forces in finance, compounding, and how small actions today can silently turn into life-changing results tomorrow. Compounding is one of those ideas that sounds simple when you hear it, but quietly becomes life-changing only when you actually experience it over time. Before we continue, subscribe, like, and comment compound if you've ever underestimated the power of small, consistent actions, because this is the point where money stops being effort and starts becoming momentum. Most people think wealth comes from big breakthroughs, big salaries, big wins, big opportunities. But in reality, wealth is often the result of something much smaller. Repeated actions that don't look impressive in the beginning. Imagine two people again. One starts investing a small amount every month. Nothing dramatic, just a consistent habit. The other waits. He says, "I'll invest when I have more money." Months turn into years. The first person continues, even when the returns feel small at the start. The second person finally starts later, but he has already lost years of growth. At first, the difference between them looks insignificant. Maybe a few $100s, maybe a few thousand. Nothing that feels life-changing. But compounding is not linear. It accelerates over time. The early growth feels slow because you're building the base. But once that base is strong enough, the growth starts to stack on itself. There's a powerful psychological trap here. Humans underestimate slow growth because we are wired to notice immediate results. But compounding rewards patience, not impatience. Think of it like planting a tree. In the beginning, you water it daily and see almost nothing. For a long time, it feels like nothing is happening. But underground, the roots are spreading deeper, strengthening the structure. Then one day, growth becomes visible. And after that, it accelerates in ways you can't ignore. Money works the same way. Small investments, repeated consistently, begin to multiply not just by addition, but by accumulation on previous growth. That's the moment most people miss. They quit too early, right before the system starts working for them. His idea, compounding, doesn't reward intensity. It rewards consistency over time. This is why discipline matters more than intelligence in wealth building. You don't need perfect timing. You don't need massive amounts. You need repetition that survives time. And if this is starting to shift how you think about small actions, subscribe, like, and comment time if you're beginning to understand that your future wealth is already being shaped by what you do today. Because next, we move into the mindset that makes compounding possible in the first place. Discipline and patience, the real foundation behind every financially successful person. Discipline and patience are the two traits that separate people who talk about wealth from people who actually build it. And the uncomfortable truth is, most people underestimate both. Before we continue, subscribe, like, and comment discipline if you know you've ever started something financially good but struggled to stay consistent. Because this is where real transformation either continues or collapses. Discipline is not motivation. Motivation is emotional and temporary. Discipline is behavioral and consistent. It is doing the right thing even when nothing in you feels like doing it. And in money, this matters more than almost anything else. Think about a simple example. Two people decide to start investing monthly. In the first few months, both are excited. Everything feels new and promising. But then life happens. Expenses come up. Temptations increase. The excitement fades. One person continues automatically, almost mechanically. The other starts skipping months, then eventually stops altogether. Fast forward 5 years. The difference is no longer about knowledge or income. It is about consistency. The disciplined person now has a growing asset base quietly working in the background. The other person has the same starting point they began with, only with memories of, "I used to invest." Patience works alongside discipline. Because even if you are consistent, impatience can still destroy progress. Many people invest or start saving expecting quick results. When they don't see immediate growth, they assume it's not working. So they quit right before momentum builds. There's a story of someone who invested small amount for years without seeing dramatic change. Friends questioned it. Why bother with such small returns? They would say. But he understood something they didn't. Wealth is not built in visible jumps. It is built in invisible accumulation. This thought, most people don't fail because they lack opportunity. They fail because they abandon processes before they mature. Discipline keeps you consistent when it's boring. Patience keeps you steady when it feels slow. Together, they create the foundation that allows compounding, investing, and long-term thinking to actually work. And here's the deeper truth. Wealth creation is less about what you do occasionally and more about what you refuse to stop doing. If this is starting to reshape how you view consistency, subscribe, like, and comment stay if you're ready to build habits that outlast motivation. Because next, we go into something even more fundamental. The difference between assets and liabilities, and why misunderstanding this single concept keeps most people financially stuck. Most people think they're building wealth when they're actually just reshuffling expenses, and the difference almost always comes down to one simple concept: assets versus liabilities. Before we continue, subscribe, like, and comment asset if you've ever bought something thinking it was helping your life, only to realize later it was quietly draining your money. Because this distinction can change your entire financial direction. An asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. It sounds simple, but in real life, this line gets blurred by emotions, marketing, and social pressure. For example, a car feels like progress. It feels like success. It gives comfort, status, and convenience. But financially, it is often a liability because it continuously takes money, fuel, maintenance, insurance, depreciation. Yet most people never think in those terms. They think in terms of comfort, not cash flow. Now compare that with someone who buys an income-generating asset, maybe a small investment portfolio, a rental property, or even a business that produces cash flow over time. At first, it may not feel as exciting as a new car or a luxury purchase. There is no instant social reward. But over time, it changes the direction of their financial life. There is a story of two individuals earning similar salaries. One constantly upgraded lifestyle items, new gadgets, better car, frequent upgrades to keep up. The other made a different decision. He delayed gratification and focused on acquiring assets first. Over time, his assets started generating returns that reduced his dependence on salary alone. Eventually, he had options. The other person had obligations. This idea, Wealth is not how much you earn, it is how many assets you accumulate versus liabilities you accept. The problem is not spending itself. The problem is misunderstanding what that spending does to your financial structure. Every purchase either strengthens your future or weakens it. Most people never pause to ask which one they are doing. And this is where financial outcomes quietly split. Not in big dramatic decisions, but in repeated everyday choices. What you buy, what you prioritize, and what you label as necessary. If this is starting to shift your perspective, subscribe, like, and comment wealth if you're beginning to see your spending in a completely new way. Because next, we go deeper into why rich people intentionally focus on assets while others unknowingly stay trapped in expenses disguised as lifestyle. The psychology of money is not really about numbers. It is about emotions, identity, and the hidden beliefs you carry without even noticing. Before we continue, subscribe, like, and comment what emotion drives your money decisions the most: fear, excitement, stress, or comparison. Because once you identify it, you start to control it instead of being controlled by it. Every financial decision begins in the mind long before it reaches your wallet. You don't just spend money. You respond emotionally to situations, environments, and internal pressure. That is why two people in the same financial situation can behave completely differently. One becomes cautious and strategic. The other becomes reactive and impulsive. Think about a moment when you felt stressed or tired. Maybe after a long day, or after seeing someone else living a lifestyle you desire. In that moment, a small purchase feels justified. I deserve this. It's just once. I'll balance it later. These thoughts are not logical calculations. They are emotional relief mechanisms. There is a deeper layer here. Money is often used to regulate emotions. People don't just buy things because they need them. They buy to feel better, to feel important, to feel ahead, or sometimes just to feel normal again. This is why financial discipline is so difficult. It is not fighting math, it is fighting emotion. There is a story of someone who constantly struggled with saving. On paper, the income was enough, but every time emotional pressure increased, spending increased with it. Not on luxury, but on small comforts, food deliveries, impulse purchases, quick fixes. Individually, they felt harmless. But collectively, they erased financial progress month after month. This idea, your financial life, is often a reflection of your emotional patterns, not just your income. This is why awareness is more powerful than advice. Most people already know what they should do with money. The real challenge is not knowledge. It is emotional control at the moment of decision. The ability to pause between feeling and action is where financial transformation begins. And if this has started to make you reflect differently on your own habits, subscribe, like, and comment aware if you are beginning to see money as an emotional system, not just a financial one. Because when you understand this fully, everything changes: how you spend, how you save. Before anything else, subscribe, like, and comment control if you're realizing that your relationship with money has been shaped more by emotion than by strategy, because this final piece ties everything together. The truth is, most people don't struggle with money because they lack information. They struggle because emotions silently override their decisions in real time. Fear tells you to avoid risk. Excitement tells you to overspend. Stress tells you to escape. Comparison tells you to upgrade. And all of these voices feel completely normal in a moment. But here's what changes everything. Once you start observing your emotions instead of obeying them instantly, your entire financial behavior begins to shift. You create a gap between feeling and action. And inside that gap is where control is born. Think of someone who finally begins to notice this pattern. They feel the urge to buy something unnecessary, but instead of acting immediately, they pause. Not for long, just enough to question it. Am I buying this because I need it, or because I feel something right now? That small moment of awareness changes the outcome more than any financial advice ever could. Over time, this becomes a skill. Emotional reactions don't disappear, but they lose power. Spending becomes intentional. Saving becomes structured. Investing becomes consistent. And slowly, Money stops being something that controls behavior and starts becoming something that follows it. There's a powerful shift that happens here. You stop trying to fix money, and instead you start understanding yourself. Because money is not just currency. It is a mirror reflecting your habits, fears, desires, and discipline. This final truth: your financial future is not decided by one big decision, but by thousands of small emotional decisions you either control or ignore. And if you've made it this far, subscribe, like, and comment future if you're ready to stop reacting to money and start directing it. Because in the end, wealth is not just about earning more. It is about becoming the kind of person who no longer loses control every time emotion speaks louder than logic.